Today on Titans Up Today, we have Nitin Shakdher, the founder and CEO of the Green Capital Group. Nitin, please introduce yourself for our audience.
Hi, Jacob, and a warm welcome to the audience of Titans of Today. So I'm Nitin Shakdher, the founder and CEO of the Green Capital Single Family Office. We are essentially a 300 million USD self-proprietary wealth, I would say an investor with our own capital. We essentially operate in the US market, UK market, India, Dubai, Singapore, and a bit of EU investments. Essentially, we are a buy-only single-family office looking at deals in the buy-only space. We operate across sectors and areas of public equity, private equity, real estate, venture capital, bonds, as well as a bit of, I would say, private equity deals and exercise. Obviously, the areas and the geographies that we look at are Asia, UK, EU, Americas, and essentially we've been an investor for the last 30 years. I'm the third generation of the single family office, and now the chief operating officer and the chief investment officer of the firm. So essentially the buck stops with me in terms of the investing activities. And happy to note that we've got a long and illustrious journey over the last 20 years of investing. And I think that's a brief snapshot about who we are.
Excellent, and thank you for that. Let's shed some light on some of those terms. What does buy side only mean for the average everyday person? How can they get a better understanding what that means?
Well, that essentially means that as a single family office, whenever we approach deals, whenever we approach any transaction, whenever we approach, let's say, a consulting firm for a deal, we'll always be on the buy side. So we'll never approach anybody to sell an asset, so to say, because selling is something that we rarely do, and we have long gestation periods of time over 6-7 years. We are essentially a buyer of assets. So there'll be many firms which essentially want to sell deals, but we are not one of them. We are essentially a buyer of investments and assets. Of course, we sell to counterparties, but we don't market ourselves. But we essentially look to go out in the market for the deal flow, which essentially is a buy deal flow for us.
Excellent. And then just to go all the way, let's say, way back into the background, what are the lessons you learned about investing early in your life?
Actually, I've made a lot of mistakes, to be honest, and I don't think without making any mistakes, you can learn any lessons. Till the time you actually lose a bit of capital, it's only when the lesson is then driven home. But safely to say, I was able to afford those losses and took them as education towards the larger cause. But essentially, the key lessons which I've learned was, one was a very key lesson in 2001, 2002, 2003, just after the dot-com and 9/11 issues in USA when we had a global collapse of investing in markets, was that historically, the periods which are depressive, which obviously are what we call in our parlance, liquidity is low, there is no traction in deal flow, people don't want to talk about investing. I think those are substantial years where you can make cumulative compounded return over the next 8, 9, 10 years if you undertake those periods. So let's say a bad drawdown period of 2001, 2002, maybe starting from 2000. And that's actually the time to not really reduce or go to cash, but actually aggressively invest. Actually, it's painful at that time because you have drawdowns and it seems like a well that you have to keep on pumping in capital, and the capital keeps on drawing down and there's a negative return. But I think what we've seen is if we see the bad phase and we hold on, the next 5 years, 6 years, 7 years periods can be humongous in terms of returns. And it'll probably really encapsulate it in a better way that those last 1-2 years of pain or 2-3 years of pain, you'll probably recover going to be very fast. So it's actually the right time to invest, which was actually a very great lesson. Going on to another incident was 2008 and 9, when obviously the valuations were very high. So I think I've also noted that there is a point to exit. Investments are not lifelong. You have to understand the different cycles. You have to know when to exit. And You have to know when the exuberance of valuations, another case in point being 2020, 2021 with technology, or 22, actually till October, November. What we are seeing is a depressive phase on US technology growth and investments, and tends to carry on for a long period of time. Because obviously the corresponding years were very, I would say, humongous and not really repeated. So there is going to be a painful period. So I think exits are equally important, which we've learned. And I think that sets the tone to compound your capital and also protect your capital in terms of an exuberant market. So I think the key lessons are, in a depressive market, keep on increasing your capital investments. And in an exuberant market, have the discipline to exit some of the investments and increase your allocation of cash.
Is your core investment philosophy consistent across all of the different segments of investing that you do? So let's say public, private, equities, venture capital. Is that same philosophy, does it carry down into all those investment activities, or are there unique elements that you're looking for?
Yes and no, because I think there are some fine differences between public equity, private equity, and venture capital. Onwards from 21, 22 onwards, I think for the next 1.5, 2 years, till we are more clear on the recession, inflation, and the high cost scenarios of the world. So I think value is currently really benefiting us. Growth is not. That's for public markets. For private markets, I think essentially what you need to look at is the vintage, and you essentially need to look at the fund cycle, and you essentially need to look at the portfolio of the private equity fund or the GP in terms of, are they in the asset valuation exercise in terms of the investing in the fund. I think depressive years when the capital outflow is less, interest rates are high, I think that's also a good time to look at private equity, because the cost of capital is very segregated, and the cost of capital goes on to companies which are generating slight more revenue. I wouldn't call them full cash flow accretive, but I call them companies which are more stable in terms of the tech startup space. So I think that's a good time to look at private equity, direct deals, and funds. For venture capital, we essentially follow the principle of looking at consumer tech a lot more, because I think consumer tech tends to go across cycles a lot better than a lot of divergent themes. With a lot of venture capital, you have a lot of themes coming into the market. They don't necessarily go on to become trends. Those themes keep on changing by rotation wise as the money moves. So, it was e-commerce 7-8 years back, then it came on to, let's say, technology, mobile technology, then it came on to EVs, then it came on to space and investing, robotics, AI, then it keeps on going back between, all sorts of newer trends, renewable energies and things like that. So you need to be very careful, yet keep an eye on the future in terms of blockchain and looking at those attributes. Not necessarily cryptocurrencies, but blockchain as a technology.
And let's go deeper on that. Are you venturing into digital assets at all, blockchain, some of those sort of investments? And if so, why or why not?
Slight disclaimer, we are not experts on Web3 or crypto assets or blockchain technology, and I'll explain why. So I think that somewhere down the line, I think what the world is witnessing is, how do we integrate the usage of blockchain technologies to a whole host of industries? And how do we look at crossing out intermediaries in the banking channel? How do we look at automation in cars? How do we look at ledger automation through a seamless process? And how do we look at cutting down the interface of even currency transfer from around the world? So I think blockchain has significant uses and impacts. I think the users are only starting out at this point in time. And we have a very long way, maybe a 10-year horizon to go in terms of how it integrates itself to the real economy and the real world and the adoption of blockchain. On crypto assets, we have just a sort of a trading view on maybe a mainline currency like a Bitcoin. If it corrects, we'll probably invest and trade in and out, but I don't have necessarily a long-term view on the currencies at this point.
Are there other technologies that have come and gone or come to fruition in your time, let's say over the last 10, 20, 30 years, that are maybe similar to what blockchain is going to experience? Let's say smartphones from or 2010 to today? Obviously, they're still going to keep going, but are there any sort of technologies you would compare to how blockchain is developing?
I actually compare this phase to a bit of 98, 99, 2000, when we were at the cusp of the internet revolution, or the World Wide Web, as what we call it. At that point in time, a lot of companies came into the market. There was a lot of exuberance, but we were a bit ahead of time, and it took time for the internet to keep pace and to identify economic objectives and to become a part of everyone's life. So I think the speed of technology is sometimes very ahead, and the consumer adoption then takes on, and the economic adoption then carries forward, and the governments and economies latch on to it. And I think internet took about, I think, adoption period of about 4 or 5 years, from 98, 99 to actually becoming more profitable 2003, 4, 5 onwards, when we started investing in the ecosystem and trying to create a large ecosystem. Until that time, people were trying to figure it out as to how does it impact me, my life, my work, my play, my office, everything. Today, everything is part of that, and we sit on a background of that. And similar to this, I would call is the mobile and the digital technology innovation. When digital and technology and mobility came into Asia, and Asia is a prime adopter of mobile technology. I think US and UK and EU haven't taken up mobile technology the way Asia has. The costs of handsets, the size of handsets, the costs of data were extremely high. And over the last 10, 15 years, the cost of handsets, applications, data, mobility, technology has really streamlined the whole process down. Today, our life is on the phone, and everything is on the phone. In fact, you rather don't actually need even a laptop or an iPad in that context. You can carry on your own life on the phone. So I think that has been a second significant shift in terms of technology. And I anticipate the blockchain, and we call it the blockchain at this point in time. I don't know what we call it in 10 years' time, but I anticipate this technology to have an even larger impact, and what we call is the Web3, or let's say the interface of the third revolution or the third internet revolution, whatever terms you might want to use. But I think it has significant impact. I think it's too early, but I think there's a lot of potential in it, and we're probably on the cusp of that. Start initial 2 or 3 years of that.
So how does flow of capital, flow and availability of capital influence the advancement of technology? So to give a little context, let's say you mentioned 99 coming into 2001, which is where an experience you started in 2001, 2003. And clearly through that time, you said exactly that the internet advanced significantly during that time. And now let's say from 08 to 2020, and now where we are today, it's really the long economic cycle of rapid and consistent growth, externality, right? Calamitous event with COVID. But now we're coming back into the market cycles changing. Do you believe does that accelerate technological advancement, or what is its influence there? Because clearly money moves things.
Yeah, I think I'll give you a different perspective. The perspective is that during COVID, technology got a huge takeoff point. There was huger adoption than many brands could handle. And people didn't envisage that this is the way digitalization could really impact. But I think that was much ahead. And also it had to do with being at home and out of home and work from home and all that, which I think will stabilize to the context of regularization of work, economy, and people and movement. And we will come back to the earlier paradigm shifts of how traveling, working, and hybrid models and all that. But case being in point is that yes, it accelerated technology. It has also deaccelerated certain things in technology, and not everything works. And I think now what will happen is that it will slowly accelerate itself into finding newer technologies, and money will find ideas which will benefit and make your and my life convenient. To give you charging points, regularization of EV, mobility, technology on EV. Today, EV adoption is a lot of electric adoption on only automation or automotive. but that is not to say that we can have energy through electricity on other applications as well. So maybe renewable sources of energy might spur on absolutely a new industrial way of looking at things. That's one key area where money will flow into. I think another area, and these periods are decade periods, right? So they're not 1 2 year periods. These are about 7 8 year market cycles of, because it takes a decade for newer technologies to establish and create a part of our lives. I think also what is important to note is food security is also and renewable sources of energy is a very important aspect of the next technology revolution. Because obviously we cannot keep on depending upon fossil fuels or old economic ways of food production or old economic ways of transportation or old economic ways of even travel. So I think that, to my mind, spurs a lot of innovation. And very interestingly, I think a lot of capital will actually flow to travel, tourism, hospitality, hotels, because I do identify that one sector which will really shine in the next 7 8 9 years. And that's historically a sector which gets beaten down, really goes on to create a very large theme investment case cycle for a lot of players in the world. Because if you see, I think the leisure and work-life balance will be even more pronounced. I think every economy of the world is moving towards, I would say, a more pleasurable work-life balance, trying to identify hours, trying to identify workforces, trying to identify, and that's true of developed economies as well as developing economies. And even countries like India, which is the fifth largest in terms of GDP and economic size, and just overtaken UK on that, and now running towards Japan and France, essentially will become the third largest after US, China, and India in the next, I would say, 3 or 4 years. Even those economics where the workforce is a lot more, I would say, I wouldn't say hardworking, but what I would say is that when you're developing a large GDP, the workforce has a different work ethic versus a developed country work ethic. So there is a fine difference in terms of resources and things like that. So I think those transformations might happen a lot more. A lot of capital will move to Asia. A lot of workforce will move to Asia in terms of challenges within Asia in terms of growth. And so I think those are some of the key trends that we work with.
And that excites me. And just to give a personal experience on that, there was a investor that I spoke to from, he went to the Korean War many years ago. He was a pilot, and then he ended up just staying out in Asia, and specifically in China. And him and I were talking, and he was mentioning exactly like you said, the work ethic there is completely different from what it is here in the US. And I think I'm a firm believer that work ethic determines a lot. And it's not just, hey, you get lucky and something happens, you create, breakthrough technology, which, hey, does happen, but it usually comes from that dedicated work ethic. And that's actually how we really drive economic growth. I start to see that top down of capital flows into those beaten down sectors, but then also there's the bottom up of, hey, people getting out there working to create something amazing.
Yeah, I think there is a reason why India and China are growing at 7 8%, of course, barring some odd years and some economic bad years. But an average case basis that China and India, with the resources and the people, of course, large populations and consumption. The key point being Japan is not. The key point being UK is not. The key point being France is not. Germany is not. The US, obviously, it's carrying on its position. So even if you look at US, China, and India, they seem to be economically and in the workforce and in terms of technology and advancements and capital flows, starting to attract a lot more institutional infrastructure development flow rather than, I would say, a UK or a Eurozone, because those economies have certain issues in terms of, as we've highlighted. And typically a rich social fabric country where there's high level of social security, you will see that there is a high level of work-life balance, but economically, the country does not tend to outpace any growth. It's just a stable growth of 1 2%. Versus a country where the resources are limited, competition is higher, intellect is far there, and a sense of struggle is there, and a sense of growing out of the rat race, trying to prove one another, companies outdoing each other, competition in the market. I don't think we talk too much about work-life balance, but it's subjective. Is the fact that I think those economies tend to do better over the long run.
That's truly an amazing segment. My mind is a little blown.
I mean, if you look at it that way, Japan was China in 1980s, the strongest power. But why didn't Japan grow in context? It then went to a 20-30-year decline of a very aging population. Not that the Japanese work ethic is anything to question, is one of the most better work ethics and the wonderful work ethic around the world, very hardworking people, but they're not necessarily the biggest of risk takers. Versus China, India, and US, where risk taking by entrepreneurship, risk taking by company innovation is far higher.
And so there's risk taking in entrepreneurship, but I know that your core investment philosophy, does the same sort of risk taking apply? Obviously, let's say you're going to invest in one of those risk takers, but how are you mitigating risk? I know that, let's say, the power of compounding is a very important thing in investing. So how do you see those two worlds?
I think the world over, every investor, whether it's an institutional investor or a fund, everyone got a very great opportunity in 2020, which was like an opportunity of 2001-2, or like an opportunity of 2008 and 9. And at that point in time, you bet the bank, because that from here onwards, everything is just going to be an upcycle, because you really have hit the bottom in terms of anything that you could do. And if you look at it, the bounce back from a very strong downfall, and economic downfall and markets downfall is a bit different. But what I'm explaining to you is inflation tends to arise because of capital flows being higher, because of profits being made. And inflation then tends to be transitory, a mild recession, things like that. But we stabilize, and then we have 2 or 3 years of stabilization. So right now we are hitting that stabilization phase of maybe 1 or 2 years, because it's very been up and down. So everyone needs to stabilize, adjust, go back to where they came from. A lot of people movement has happened also. Like, for example, Singapore has lost a lot of expats. A lot of expats have moved to Dubai. To and fro traffic has been there between UK, US. So there's a lot of people movement, manpower movement that will stabilize. And companies will start expanding in capex and investments soon. I think by this year, next year, when things are stabilized more. And then there's a consolidation phase period, right, which typically would last for a year or two. Then we have a slow upside. Is economically, and global economies are all interlinked, is that inflation is under control, and economically every country is growing as per its potential. So while Europe, UK will grow at 1-2%, US will be at 2-3%, China and India continue at 6-7%. So I think that cycle will come, and that economically then tends to have a large. What we need to see is consistency, not of asset classes, but consistency of corporates investing, globalization, plant, manufacturing, jobs, allocation of capital, and this spurs on every other ancillary industry as well. And then obviously money flows to innovation as well.
Outstanding. Very enlightening. That's going to be a key piece for a lot of people to listen to it over and again. So what sort of investment proposals, opportunities, and other things of that nature are you open to for your business specifically right now? Let's say there was a investor or a entrepreneur who was listening to this that maybe wanted to engage with you. What would be that best sort of thing that would fit your scope?
I think what we're looking at is certain companies that are changing the way we live, work, and play. By that, ultimately, everything is consumption. Now, consumption is a trend, whether you call it technology consumption, whether you call it asset consumption, whether you call it energy consumption, whether you call it resource consumption, whether you call it entertainment consumption, whether you call it data consumption. So we're looking at consumption as a prime theme. Now, based on that, I feel that data, mobility, I would say energy resources, I would say food, I would say consumption of goods, and I'm not talking about luxury items, but necessities, is a very important theme continuing to go forward. I do feel that education and healthcare is also one consistent theme that is across geographies and across countries, tends to do well. So I think those are some of the key themes we're looking at. Obviously, we're looking at both direct and indirect investing opportunities in all this. And that would mean taking small SME investments in companies which are focusing on these themes. That would mean taking direct stakes in smaller companies which are trying to work on these themes. And they could be in Europe or in US or in UK or in India or even in the Middle East. So I think that's a very interesting theme that we look at. Obviously, we don't look at ideas and startups which are just value driven valuations. We don't look at that. We actually look at some work being put, some investments being put, some revenues getting generated, and then only we come onto the investment table.
Excellent. And it's greencapital.net, correct? Your website?
The Green Capital.
Outstanding. Now let's say, look, however many years forward you see, what are your primary goals for yourself?
The primary goals is to survive the investing markets, because I must tell you that if you tend to survive, then you tend to thrive. The idea is always to create investments that it's a combination between risk, innovation, and also to look at a combination of, I would say, asset protection, steady cash flow, steady deal flow, because you need to generate cash flow on your investments so that you can then take on the risk adjusted investments, which some might work and some might not. And you have to understand that every investor makes mistakes, we do too, and we continue to make them. And that's fine. We embrace them. We don't run away from them. But what we tend to do with these mistakes is we tend to really find a thesis that what works and what doesn't work, and try to funnel the process down. Going onwards, our investment hit ratios are 70%, 80%, 90%. So even if some 10% investments go wrong, it doesn't really hit us that bad. So I think that is always an endeavor in the future, in the next 10, 15 years. You never know where life takes you, whether we are there, not there. But I think what is very important to note is that time is limited. Resources are not, money is in abundance, but your time is limited. And you're here, and we all think we have large lifespans, but we don't. So I think you should compensate and live your life and enjoy your work, enjoy your process, enjoy investing wherever you are each day. Make it the last day, make it count. And because you don't know what the future holds and where you will be and what will be the situation. Health is very important for us as a priority. We focus on health being the wealth, real wealth actually. Rest is, money is there, money is not here. It's not a factor that affects us, but I think it's good to be healthy. And I'm sure if you have longevity, then you will be wealthy in that sense.
Outstanding. This has been just a wonderful segment. So thanks for being on Titans Up today. We'll see you in the next interview.